At Passionate Property Investors, we hear from a lot of infinite learners who love to know more and share more about their property knowledge and investment journey. If this sounds like you and you want to get more education where your eyeballs are, then join us on Facebook at Passionate Property Investors. Videos, ebooks, and learning pathways to get your property cup filled up. Not to mention free education with a tribe who gets it. Join today by searching Passionate Property Investors on Facebook.
Welcome to the Smart Property Investment Show with your host, Phil Tarrant.
G'day, how you going? Welcome to the podcast. Appreciate you joining us as we navigate property and property investment, and it's a good time to be a property investor. My view, speak to other people, depending on how you get your information, you probably hear something very different. It's, I think, the right of all Australians to complain and pretend to be an expert around property, and I'm definitely not one of them. I like talking about property. I'm fortunate I get to bring people into the studio to have a chat to me about property, and that's how I learn. That's how I become more informed and better educated and a smarter property investor. So you've got to be careful where you get your info these days, especially in a market which is in flux. And again, you can choose to understand or appreciate or have a relationship with what flux is. And flux is either it's really bad and everything's going wrong, or it's a great time to be a property investor. In my view, always a great time to be a property investor. It just depends where you're buying, how you're buying, why you're buying, and how good your finances are. And if you've been in property for a while, as I've been, you will know that property is a game of finance, and those people that have their finance best set, best structured, with the best or the most appropriate loans for their investment needs are often have the advantage, whether it's come to buying a property or holding on the property. So it's a game of finance and it's a game of cash flow. Sometimes I feel like we're doing it to death, but I constantly hear from our rapidly growing community of property investors that it's good to reaffirm, re-educate, and just reconnect with where you are with finance. So my objective today is to have a chat about finance in the current market, and there's always a theme we can do, finance in the current market. And my guest today, Marissa Schultz, is a mortgage broker. She was back in the studio on the 27th of September last year, so nearing a year or so ago. Then we spoke about finance in that market. Today she's come in and we're going to have a chat about finance in a very different market. Marissa, how are you going? You well?
I'm great. How are you?
I'm very good. How different is the market 9 months on from when we last spoke?
Oh, well, so much has happened, you know. I guess the banks have just taken a beating from ASIC, from APRA, from the Royal Commission. That's now all over, which is great because we now are moving to a state of stability, or that's where we're heading. So I think that obviously, over the last 12 months, we have had a lot of tightening in lending in a lot of areas. So most Australians have found that their borrowing capacities have reduced, and most Australians are in the position that if they go to their bank to even refinance their existing debts, the banks might say that even though they are actually paying off their debts quite comfortably and still have money to save, that they can't actually afford to service their existing loans. I think that what we're going to start seeing moving forward is we're going to start to see a new norm. We're going to start to see some common sense coming back into lending, which is something that I really welcome. So we've already seen a little bit of loosening of the reins with APRA coming out recently, basically taking the obligation off of the assessment rate of, over 7%. So we had all banks basically being dictated as to what the assessment rate would be. And the assessment rate is, of course, the interest rate that the banks have to use when they work out whether you can afford the loan. APRA's now come out and said that banks can actually return to making up their own assessment rate. Okay, so that's going to mean what we're going to see is we're going to start to see different lenders having different assessment rates again, like we had previously, and they're obviously going to base their assessment rates on their risk appetite and their risk level. But what we are going to see is the assessment rates are going to be much closer to the current interest rate levels than what has been the case in the last 12 months. So I'm hoping that in the next sort of 4 to 6 months, we're going to start to see that change filter through. That in itself is going to increase people's borrowing capacities, just that one small change. I think the other area that has really tightened people's borrowing capacities in the last 12 months is the real focus on living expenses. So a lot of people still are struggling to realise that expenditure that they've been making for the last sort of 3 to 6 months is really hurting them when they go and do a loan application, because many banks are reviewing that with a fine-tooth comb and saying, okay, well, you've spent $5,000 on average per month for the last 3 to 6 months, so that's what we're going to use for your living expenses. But what we need to understand is that within those living expenses that have been spent for the last 3 to 6 months, there may be some one-off larger expenses. Maybe they bought a new piece of furniture or went on a holiday, or maybe there is a large portion of discretionary expenditure that can be tapered back if required. So I'm hoping that we'll start to see ASIC have a little bit less pressure on the banks in that area and give the ability for the banks to put some common sense behind those decisions when it comes to living expenses and be able to separate what is essential living expenses versus discretionary living expenses, so that when we are doing a loan application, we can get more realistic view of actually what is the customer's, necessary living expenses moving forward beyond the date of getting that loan. So I think that there's a couple of areas that are really going to change borrowing capacity for a lot of borrowers in the future, and potentially people that have struggled in the last 12 months to access the finance they're looking for to get their investment property or to refinance their loans to better rates. These loosenings might actually give them what they need to boost their borrowing capacity to a point where they can actually do what they want to do. So I think there's a couple of areas that will make a big difference for them moving forward.
So in summary, 9 months on, it's much better than what it was back then.
I hope so. Yeah, definitely. I think it will be. And I think that, I guess following the Royal Commission, I've, been fortunate to be able to spend a lot of time with politicians lobbying for things that I believe in that are really important to ensure that
Who are you lobbying on behalf of? Like, is that just you?
I'm just lobbying on behalf of my clients, Phil.
Okay.
I mean, at the end of the day, I care about my clients, and my clients want to, they want to buy property, they want to invest in property, they want to grow their wealth, they want to be in charge of their own future. And I think sometimes politicians and governments make decisions based on what they think is right, but don't necessarily understand, the implications for the mum and dad investors or the people that are actually just really trying to get ahead.
Are they happy to chat to you? Like, are you actually getting much access to these politicians? Are they,
yeah. I've been really amazed at how open they've been and how willing they've been to listen. And I think, obviously leading up to the election, there was a lot of uncertainty about what was going to happen. And obviously it was a very surprising result for most Australians. I certainly didn't expect the result that we got, but I was very pleased with the result that we got from the election, because I guess from my discussions with politicians on both sides of government, I do feel really confident that the Liberal government do want people to buy property and do want to fix what is happening. They see that there is a credit crunch and they don't want that to happen. So I feel like they do want credit to be loosened, not to a ridiculous point, but just to be loosened enough so that we are applying common sense to these decisions, and, we are, people are able to invest in property again. And obviously, with the election result being over, we have certainty again in relation to tax benefits of investing. And
I read a thing in the Daily Mail, which obviously is a very good publication for getting all the information you need around celebrity gossip, but I read it most nights, and it was a piece written or referencing the barefoot investor. I can't remember, Scott Pape or something, I think it is. By the way, his stuff's pretty good, but there was a conversation or an article of him saying Australia is just about to enter or become the next island around sort of the global financial crisis time, when 50 or 60% of the value went out of property prices. That's the market we're heading into. And I think also quoted within that article was Martin North, who's always been a doomsday predictor of markets to go south by 40% and all this sort of stuff. So the market's changed since we last got together in September. What we do now know is that we've gone through the Royal Commission. We know what the outcome of that is, and it's good for mortgage brokers. And we have
and it's good for our clients.
And it's good for your clients, absolutely. And then you've got coalition government's been elected back into power. You've got APRA softening stuff, and we've spoken a fair bit about that on Smart Property Investment recently. But there is still this sort of this cadre of people who are saying Australian property market is overcooked, and by reducing interest rates, which have just done this month by 25 basis points, and the banks have passed them on to various degrees, and we'll have a quick chat about that. That means more Australians, and the softening or the less oversight on the serviceability. So banks can now start going, this person looks like they can pay it off, that they're going to flood the market with property investors and people who are buying property who are going to overcook the market, and it's all going to fall into pieces. What's your view of all that?
Look, I've been investing for nearly 2 decades now, so And over that period of time, there has always been someone saying that was going to happen. And it hasn't happened. So I guess from my perspective, yes, there's ups and downs. But when you look at the long-term average, property is still outperforming. I think I was looking at the Russell Index recently, and over the last 20 years, property has outperformed every other investment vehicle, including shares, and that's publicly available information that you can get on the internet. So I think there is always. I decided very early on in my investment journey that I would ignore, those doomsday articles, unless
people at barbecues telling you about it. Yeah,
I guess it's like what you said at the beginning of the interview, that it's really important that you are careful about where you get your advice from. The Barefoot Investor, he's got some really good content and really helpful to people about learning good money management habits, but he is not pro-property. And that's fine. Everyone has a different investment vehicle that suits their comfort levels and that suits what they want out of their journey. I think that we need to look at the fundamentals. And right now we are dealing with a situation where interest rates are at historical lows. We're about to get another rate cut. So that is obviously making property more affordable. We're looking at an environment where the government is going to be bringing more stimulus in for first home buyers, which should, raise demand from first home buyers, and help out in that area as well. We're looking at an environment where we're going to see lending criteria soften to a reasonable level. So I think we've got a lot of things leading to the fact that the next 12 months are going to be a good time for property prices in Australia. And I do see positive signs ahead. And, from a demand and supply perspective, our demand as a country still outweighs our supply. When we look at the numbers of population growth, sure, there's different pockets and different types of properties that you need to be careful with, but if you stick to the basics and the fundamentals, then I think there are really good opportunities in property, for the next sort of 12 months. I think we will see growth in property prices. That's my prediction.
Marissa, I want to have a chat to you about how you can present yourself better to a lender, but before that, just a quick break.
Creating financial freedom is every investor's dream. Best-selling author and director of Pure Property Investment, Paul Glossop, is giving you that chance. To grab a copy of his new book, A Surfer's Guide to Property Investing, absolutely free, simply jump onto Pure Property Investment's Facebook page, hit the message button and type the words Smart Property to secure your free copy today. But hurry, this offer is limited to the first 100 people.
All right, Marissa, we're back. We're having a chat about how Australians can better prepare themselves for secure finance, and we've painted a reasonable picture about better conditions for borrowers moving forward, property investors moving forward. You touched on this really briefly, that APRA's recommendation to the lenders is to soften some of the assessments around whether or not a borrower should get a home loan. And one of those things you spoke about was them sort of going through a fine-tooth comb in your finances. And banks are always going to do that. They've got to work out whether or not you can afford a mortgage, whether you're owner-occupied or an investor with multiple properties. How can you fix the package that you put in front of a lender pretty quickly, or say a 2 to 3 month window, to be more attractive to a lender at a point in time?
Yeah, absolutely. That's a great question. And there are things you can do at the moment to really make yourself more attractive when you do go to apply for a loan. The first and most obvious thing is to try and reduce your living expenditure. Try and reduce your living expenses and keep them to a minimum as much as you can, because now we're in a situation where the banks will take your actual living expenses as demonstrated historically. So, leading up to a loan application, if you do have the ability to cut back a little bit on the money that you're spending, that's going to help to basically have a lower living expense rate that has to be entered into the bank's calculator when they determine your ability to afford the loan. I think the other thing that's really important is that, more important than ever before, is that people really need to protect their credit rating. And people don't really understand still what credit rating is, but the reality is that 99% of the banks are now using a computer to assess an application before a human sees it. And that computer is assessing it based on your credit score. And not only on your credit score, but moving forward, we're going to have a situation where banks can see a lot more of your personal data. And that includes things like if you're late with a payment and you haven't made, you're late by two weeks of a credit card payment. Now, I know a lot of Australians who have a lot of money in the bank and can afford to meet all of their obligations, but maybe sometimes are just a bit forgetful to pay their bills on time. That's going to start hurting them. So it's a matter of just making sure that you are meeting your obligations on time, that you are paying, basically paying everything on time so that you're not impacting your credit score, that you are limiting your credit applications. So trying to avoid things like payday lenders, trying to avoid...
Does it all show up like an afterpay or...
Yeah.
So if you enter into a facility with afterpay to... I saw a thing that you can even get your medical stuff done or your teeth at the dentist on afterpay. Does that come as a line item in your credit history?
Absolutely.
Yeah.
Every time you apply for any form of credit, even if you're doing like a rent to buy thing or an interest-free terms on a purchase of a lounge or a fridge or something, those things actually hurt your credit rating more than people understand. So I guess, personal finance applications like your payday lenders and your rent-free, your interest-free stuff and your credit card applications, especially if there's multiple of them, they can actually hurt your credit rating quite substantially. I don't know if this is going to happen, but my gut feel is that, as the banks have access to more information, which is starting to happen, and that's going to continue to happen moving forward, I wonder whether the banks will start to bring in risk-based pricing. I mean, we already have risk-based pricing to some extent now where people with good credit scores have access to cheaper interest rates and people with poor credit scores have access to more expensive interest rates. But right now, there's quite a big difference between, good and bad. I wonder whether there's going to be more of a scaled range where we're going to have good, medium and bad moving forward as banks are able to find out more about people's spending habits and people's payment habit, like repayments habits. So that would be an interesting thing. One thing I am hoping to see though is I think that with the recent rate cuts that we had, it was really interesting to see what happened when the banks decided what they were going to pass on.
Yeah.
And I thought Westpac and Bank SA made a really interesting decision because they decided to reduce the interest-only investment rate by more than the owner-occupied rate. So that, for me, is a sign of what I've been predicting, is that hopefully we'll start to see the gap between what the interest rate is for investment loans and the interest rate for home loans start to narrow again. So hopefully, that's something that we might, watch this space and see what happens there.
There's a lot of indicators and your mortgage broker should be able to help you out with it. If you're trying to do it yourself, you're just going to struggle to get the info. But one of the other sort of changes out of APRA was the reduction of this rule of trying to slow the rate of growth of investment-only lending from banks. So that's softened it a little bit.
Absolutely.
So when you see that happening, it means that Westpac wants investment business, is what it says. So they're looking to grow their investment book. So that's a good sign. And
we've also seen some other lenders come out and offer investment loans at home loan rates, as sort of policy exceptions. So it is starting to happen. And I think that's more good news for investors. So from my perspective, I can only see good news for investors moving forward. I think there's a lot of positive things that are going to enable people to achieve their investment goals when, maybe they haven't been able to in the last sort of 12 to 24 months.
So just going back to sort of trying to clean up your finances to present a better package to a lender, I speaking to my broker the other day and he said that the lenders got so bad that one of their clients was withdrawing cash out to pay for stuff.
Yeah.
And they wanted to know what all the different cash withdrawals were around and what they were for.
Yeah.
Which is absolute madness. I like to pay with cash for stuff, but like you can't get a takeaway these days and pay with cash. It's nearly impossible, right?
Yeah.
So, I know a lot of people actually have an Uber and a Fedora or Uber Eats card, which is completely separate from all their other finances, so it doesn't show up on their statements when they put it in front of a lender. Do you see that sort of happening? Are people doing this sort of stuff?
Yeah, look, definitely. I mean, I think banks are very nervous when they see customers that are taking big cash withdrawals and they can't identify where that money's going. So it's a really fine line between between how you manage things. I mean, ultimately it's the bank wants to know how much you're spending and what you're spending it on, and they feel more comfortable when they can see what you're spending it on. So, there was a situation, we did have a situation actually with a customer who was withdrawing large amounts of money or regularly withdrawing, a few $100s each Friday or Saturday night at an ATM machine located near a pokies hotel. So the lender decided that person was a gambler. Now, I mean, obviously, that's a big assumption to make.
Yeah.
But that's an example of if they don't know, then they'll err on the side of caution. So
It's hard.
I think,
So, the people draw assumptions based on the technology or knowledge they have. If you always take in $100 or $200 out at the pub every other night, they're going to make assumptions around your drinking habits.
It's quite logical that money is being used for other purposes as well, But I guess and then that's when you need a really good mortgage broker, fighting your fight for you and being able to tell your story. But I think the reality is that it just comes down to the fact that at the moment, the way that lending is, money that you spend will bite you. So just,
So you generally need to change your habits.
Look, I mean, it is good money management to try and cut back on your spending and save more of it, invest more of it anyway.
Absolutely.
So it is, trying to, I guess, encourage better behaviours in people and making sure that you're not spending excessively. But, people that are able to spend less and save more, they will benefit. They will have a higher borrowing capacity. So I guess it depends what your priorities are in terms of, whether you do want to borrow more, whether you're quite comfortable with your position currently. But, what you spend will come back to bite you when you do a loan application. Now, there is still quite a variance between the lenders. Some lenders need to see your bank statements and will pull apart every item line by line. And then there are other lenders who are a little bit looser on it. And maybe
your broker should know that. Your broker's going to know which lender is going to
That's right.
pick
So,
through things.
From our perspective.
Who's the worst, by the way? Who's the worst lender at the moment with going digging down to the umpteenth? It's
I don't want to.
It's not a name and shame, but
Look,
what colour is their logo?
Generally, the lenders that offer low deposit loans at high LVRs
don't really care that much.
No, that's when they're going to be very, very particular about spending.
Okay.
Because if you're not coming to the party with a lot of security, so probably the higher your loan to value ratio, so the more that you're borrowing, the more debt you're taking on compared to the value of the property, that's obviously a higher risk for the bank. The more they're going to scrutinise the application. The less that you borrow, like the lower your loan to value ratio, probably the less they're going to scrutinise your application, and that makes perfect sense. But I think it's just a matter for, what we do with our clients is we basically screen their living expenses before we even decide on a lender.
Yeah.
And that's what your mortgage broker needs to be doing.
That's what a good broker should be doing.
Because we need to try and identify what will the banks pick up on, what will the problems potentially be, and then find the right lender that's going to ensure that application goes through as smoothly as possible. But you need to find a broker that is actually asking you all of those questions and pulling your living expenses to pieces before you actually even choose a lender and decide
it's a really
who
good
you're
point in terms of choosing a mortgage broker too. You're really clear on the fact that the more times you apply for credit, can potentially raise more red flags about whether or not you're credit worthy. So
absolutely,
this all comes up. So if you're mortgage broker, you can get your home loan, then they shop out an application to 4 or 5 different lenders. They all appear. Yeah. They all appear.
That's really bad for your credit rating.
That's bad for your credit rating. So your broker should not be doing that.
An application should not be submitted with a lender unless you're 99.9% sure it's going to get approved. Yeah. And a good mortgage broker will actually be able to determine whether that loan's going to get approved before they submit it.
Yeah. They should know.
We shouldn't be, we would never submit a loan unless we were 100%, or when I say 99.9% confident that it was going to get approved, because you just can't take that risk with the person's credit score. It's too much of a risk for them, and the credit score hangs around for too long to put them under that pressure. And that's probably another sign for people that are getting pre-approvals. Pre-approvals serve a great purpose, but don't shop around with pre-approvals either.
Yeah.
Don't go and get pre-approvals with 3 or 4 lenders. Just get one pre-approval with the bank that you're most likely to go with, once you actually find the property, then you can review and decide, is that bank that you got the pre-approval with, is that still the best option for you, or should you get another lender? But definitely you don't need multiple pre-approvals, you just need one. So just make sure that you are careful with, what application forms you sign and, how many applications are submitted under your name, because it does impact your credit score. And I think credit score is a hard thing to fix once it's broken.
It is. And Marissa, I want to have a chat to you about what and where your clients are buying. But before we do that, I just want to go to a quick break.
We get it. You're here listening to the Smart Property Investment Show and you're being interrupted by this ad. We value your ears just as much as your eyeballs, so we'll be quick. Join passionate property investors on Facebook today and we'll fill your Facebook feed with useful tips and tools, plus free education from industry experts and a tribe of people who get it. Passionate property investors. Find us on Facebook now.
I've got Marissa Schultz in the studio. She's from Adelaide, and I cop a little bit of a flack on the show sometimes that I don't talk about Adelaide enough. So I'm going to use this as an opportunity to get a better understanding and appreciation of the Adelaide market. Why don't I cover too much off Adelaide? Well, most of the commentary on the Smart Property Investment Show normally follows where most properties are being bought and sold, and that's the East Coast. But Adelaide is a vibrant investment market, and I'd like to think that we do cover it quite well. You're Adelaide born and bred, is that?
Yes,
is that you
I
are?
am an Adelaide girl.
Adelaide represent, yeah.
Yes, I love Adelaide. Yes.
So what's Adelaide like today than compared to what it was? Sort of, you said you've been investing in property for 2 decades.
Yeah,
I don't believe it. You can't be that old, but anyway.
I started when I was 18.
Okay,
so
there you go.
Yeah.
I was going to say that was a compliment. So,
yeah, thank you.
What's going on down there? What are people buying? What sort of stuff?
Look, I think what makes Adelaide really attractive is the things that make Sydney and Melbourne really unattractive, in the sense that, Adelaide.
The people?
No, not the people. I don't know
if we're going to invite her back up here again.
Look, Adelaide has got great rental returns. So, one thing that's going to be really important moving forward, especially, with borrowing changing, is cash flow, like you said. It's the finance, but it's also the cash flow. So obviously having those better rental returns means that you're having to pay less out of your own pocket to hold those properties long term. Now, at the end of the day, if that is the difference between you getting in the market or not getting in the market, we find that a lot of interstate investors will start to look to places like Adelaide when they can't get the rental returns in their own cities. So I think, the rental returns are definitely a real positive for Adelaide. I think we've also got really low vacancy rates. It's less than 2% across the CBD and the metro areas. So I think, we've got good rental returns, we've got low vacancy rates. Adelaide is thriving, I think. There has been a lot of development and investment in infrastructure in recent times, and I think that Adelaide is that slow and steady story.
Yeah. So
we don't have the ups and downs that Sydney and Melbourne have, but that's what makes Adelaide attractive, that we don't have the ups and downs. Yeah, Adelaide has still performed well. I've started nearly 2 decades ago, and my properties that I bought in Adelaide have done what they were supposed to do. They've doubled twice in those 2 decades. So Adelaide has, done what it was supposed to do, and I think that there's a lot of positive signs now that it's Adelaide's turn to have a bit of growth with the property prices. So I'm putting my money on Adelaide for the next 12 months.
Well, for people who are sort of infrastructure orientated or more economic orientated, and that's how they sort of part of their narrative. There's quite a lot of stuff going on in Adelaide. There's a lot of money getting spent.
There is a lot of money getting spent, and we've got a lot of really good areas, up and coming areas near the CBD that are really good price point. You can get some really good investment properties, under the 450 mark, 5Ks from the CBD. So, that's an attractive price point for investors to actually get in, and we've got a great, international student, group in Adelaide as well. So we do have a vibrant city, and I think we do have some really good signs that, Adelaide could be geared up for some good growth over the next 12 to 18 months.
Check it out. Adelaide, there's so much information around Adelaide. Go to smartpropertyinvestment.com.au. You can search any particular suburbs where your investor clients are buying.
Oh, look, really everywhere, depending on what they're trying to achieve. If cash flow is really tight, then they might be looking at more of the outer suburbs where they can get, almost positively geared properties or, close to neutrally geared properties, because that means that, it's more affordable for them. Yeah. But there's, like I said, there's some really great land opportunities, within 10 Ks of the CBD, that for those investors that are, keen to add their own equity growth through renovation or subdivision or development, there's some really good opportunities to do that as well. So it really depends what they're looking for, but there's lots of good opportunities scattered throughout Adelaide and the metro areas that I think, probably the only thing I'd be avoiding is apartments.
Okay.
In the CBD. I think that's pretty...
Like new build, high-risey sort of. I guess there's no building in Adelaide over like 3 stories, right?
Oh, Phil, you haven't been to Adelaide recently then if you think that. We've got a few over 3 stories.
Send your hate mail, editor at smartpropertyinvestor.com.
I'm not a fan of apartments, but apart from that, I think there's a lot of good buying opportunities.
Okay, well, go and check it out. Marissa, thanks for coming and having a chat.
Yeah, thanks for having me.
Always enjoy it. It's Marissa Schultz. She's from a company called Rise High. So it's just Rise High. It's not financial.
Rise High Financial Solutions.
There you go.
Yes.
And what's clear to me is that you need to make sure you get a good mortgage broker. It might be a good time to be buying property, but if your mortgage broker ain't no good, it can set you back. But
absolutely.
Yeah, nice one. We'll see you when you're in town next. Thanks for coming up.
Thank you so much.
Good one. Remember to check out smartpropertyinvestment.com.au. If you're not yet subscribing to our morning newsletter, so they're first to know what's happening in property and property investment right across Australia, smartpropertyinvestment.com.au/subscribe, or social media, just search for Smart Property HQ. You like us there. If you like what we're doing with the podcast, remember to check that subscribe button wherever you listen to it, so you make sure you get every new episode as it becomes live. We'll be back again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.